Welcome back to Accrued Interest. Today, March 21st, 2025, I'm doing part 3 in my ongoing series where I analyze the merger between FuboTV and Hulu plus Live TV. As always, a brief disclaimer, everything said on this podcast is for entertainment purposes as I am not a registered investment advisor. So in part 1, I discussed the strategic rationale for the merger. In part 2, I did a deep dive on the Q4 2024 earnings release for FuboTV. In part 3 today, I'm going to show you how you can go into the investor relations deck, look at the management's forward projections, read between the lines with a little bit of math, and decide for yourself whether or not management's projections are reasonable. First, you want to reverse engineer the numbers that the company's management gives you publicly to sanity check them. Secondly, you want to look at whether or not the baseline that management has established is consistent with current business trends. And lastly, I'm going to leave it up to you to decide whether or not you believe estimates are too high or too low, and whether or not you want to stick around for the merger. A quick recap from last time, Hulu is going to account for about 70% of the subscriber base in the new company. I would argue that this merger is really a backdoor IPO for the Hulu plus Live TV business. In the management forecast, the company believes they'll be able to grow revenue over 10% year over year. This is a bit slower than the 24% year-over-year growth that FuboTV was having on its own. Fubo started with about 1.6 million subscribers, and the new co is going to have about 6.2 million. In the slide here, I reproduced the numbers that management put forward, except I changed the order. The new company is expected to have 6.2 million subscribers. Since Fubo had around 1.6 million North American subscribers, it makes sense that they're saying Hulu has about 4.6 million to bridge the difference. What I want to draw your attention to is how I use back-of-the-envelope math to see what ARPU, that stands for average revenue per user, assumptions is management implying in this new company, starting from a total revenue base of about $6 billion. If you divide that $6 billion by the 6.2 million subscribers, that comes to a monthly annual subscription revenue of about $80.65 per subscriber. Doing the same math on the Fubo numbers gets me an ARPU of around $83. It's a little bit lower than what Fubo has been doing in some of their publicly stated financials, but remember, going forward, they dropped some lower ARPU subscribers who are no longer with them ever since they parted ways with the Univision channel. Now, what I think is interesting is that if you do the same math on the Hulu subscribers, it implies an ARPU of around $80 a sub. Next, I want to look at management's forward forecast to see what sort of revenue growth are they implying and ask myself, does this make sense? In 2026, Fubo plus Hulu Live TV is expected to do a median revenue of about $6.75 billion. In 2027, the median is about $7.25 billion. And in 2028, the median should be closer to $7.8 billion. Something that makes me wonder what's going on is that the implied growth rate in management's own forecast is actually less than 10%. We just have to ask ourselves, where is the 10% growth expected to come from? Is there something that I'm missing here? Or is management's math not fully adding up? Here's what worries me. Hulu's live business has been stuck at 4.6 million subscribers for some time. Remember, this is about to be 70% of the new company. I had to go back to the fall 2022 to see the last time that Hulu's subscriber numbers were actually lower. Back in October 1st, 2022, Hulu's live subscriber numbers were about 4.4 million. So that is effectively telling us that Hulu's live TV subscribers only grew about 5% over the last 2 years. That is very concerning, and we're going to need to hear from management what their plan is to reaccelerate growth if we really want to believe their forecast that they're putting forth in this merger. Next, let's talk about profits. In this case, adjusted EBITDA. I'm also concerned that even in management's 2028 bull case, EBITDA margins are expected to still be thin even after the merger synergies were applied. The EBITDA margins are expected to go from about 5.2% in 2026 to about 7.7% in 2028. Those margins are still thin. This is a very high fixed cost business, and if there's ever a hiccup in revenue, you're going to expect these EBITDA numbers to come down quickly. Doing the exercise was very helpful because now I have new questions for Fubo and Hulu's management. First, we're going to need to hear from management how they plan to grow the Hulu live business at 10% a year after years of no growth. Secondly, is future growth expected to come from subscribers or price increases? Because I already explained to you how we're not really seeing much growth in the subscriber base. And lastly, are there more synergies to be found? Because having EBITDA margins less than 10% 3 years from now in the best case is still pretty thin. As always, thank you for listening. Don't forget to like and subscribe. And in the comments, let me know, what are your thoughts on management projections? Do you think that they're too high or too low, or is there something else we should keep in mind? Thanks again.